Hey everyone, and thanks for jumping back into the precious metalverse. Today we're going to be talking about gold. We're going to be doing an update to the last video we did on the regression line for gold. So if you're not familiar with the channel, we look more into a quantitative finance approach, more of a data science rather than traditional TA. So if you guys like the content, please subscribe to the channel. We'd love to have you join. Also check out some of the links in the description below for more content. So let's go ahead and jump in. So in the last video on gold, we showed this fair value regression line. And this is a logarithmic regression line that is fit to the equation 10 raised to the power a times the L of x minus b, where a and b are fitted coefficients, fit to minimize the sum of the logarithmic difference between the price and the regression line. And then x is just time. So this is what we have. This is the regression line that it came up with, and our current fair valuation, quote unquote fair valuation, according to this line for gold would be around $1,404. And we went over this in the last video. We showed the price versus the regression line and made comparisons there to some other asset classes like Bitcoin, and so on and so forth. We also showed these lines here, and just bear with me, I know it looks like a complete and utter mess, but there's a method to the madness. Basically just connecting, this is macro level views, right? Not microscopic views of daily analysis, but macroscopic views. So we connected the purple, connected our peak to our peak, the red from the bottom to the kind of the movement to below the regression band to the peak. The yellow was bottom to bottom, and then holding support this time, and then the blue was our trend downward from 1980 to 2000. So where are we today? We're right here. We're just above the fair value regression line, and we set our most bullish scenario that we can imagine really would be coming back up to our red line, which we've been in 3 times. It used to be our bottom here. It was where we broke through the fair value here. It was our peak here back a decade ago or so. And then now, if we were to come back up to it, then it might be, it could be the next, say, paradigm shift in the price of gold. And, if you notice, this over here is a logarithmic scale. So this would be 1,000, 2,000, 3, 4, 5, 6. So maybe it would put us somewhere between, $4,000 to $6,000 per gold, or for the price of gold for each, if we were to come back up to this regression line. Now, that's just to get you caught up in case you missed the video last time where we showed the regression analysis. If you didn't see it, I would encourage you to go watch that video because we really dive into what's going on here. One of the things you can see kind of an interesting pattern that may or may not play out again, but you can see kind of coming from below the regression band, coming up back above it, coming back into the regression band again, and then going parabolic, okay? So below it to above, test the regression band one more time, and then go parabolic. Similar thing that's happening over the last 2 decades. So come from below the band into the fair value region, above it, like we did here, come back into the regression band, and then maybe go parabolic. But we also know that the market, as we go forward through time, like most markets are maturing, they're becoming more efficient. You can see that, the time spent below the band is getting longer and longer. The time spent in the band is getting longer and longer. And a parabolic move above the band would likely not look, the angle of attack on the price chart would not look as steep as this one. So with that in mind, I want to segue into TradingView because I want to show you guys another perspective here as well. So this was our move here in February of 2001 to August of 2011. So this was a 10-year move. During those 10 years, the price of gold went up around 622% over the course of 126 months or 3,833 days. Okay. Now, if we were to take, if the same move were to happen from our bottom here, or you could even take it from over here. If we were to take it from this point and we were to go up, say, another 600% over the course of 3,833 days, then that would put us at around a $7,500 gold in the first quarter of 2026, if we were taking it back from this point over here. If, on the other hand, we just measured it from, say, our local kind of our last test down into the regression line, then it might put us, if we go up, say, 600% over the course of the same period of time, it might put us at, say, like an $8,300 gold in in April of, say, 2029. So this is what I want to draw your attention to. Now, let's measure to see if if we can even compare these. I mean, one of the things you can do is you can look at the angle of attack here and see at what rate were we going up. You can see that in this line, I mean, sometimes we were below it, sometimes above, mostly below this line. But if you just take it from the bottom to the peak, then it's around 46 degrees. If you kind of try to encompass more of that price movement, you can see it's around 42 degrees. But just drawing from bottom to peak, the angle of attack is 46 degrees. If we take this as our bottom and go up our angle of attack out to our next theoretical move to 60, if we were to say 82.58, this would be an angle of attack of 46 degrees, which obviously makes sense since we're just comparing the same price move up over the same length of period of time. But it's interesting because you can see that our price movement is roughly similar in terms of what we have done over the course of the last year or so. So if we were to take, say, a measured move that just shows the date range from August of 2018 to now, you can see it's about almost 2 years or so, and we're actually holding that same level of, or our same angle of attack as we did in the last move that also culminated when there was a lot of turmoil in the stock market from the dot-com bubble. So this obviously is you might look back at what's going on today with the pandemic and everything, and looking back on it, it might seem okay. Well, it was a fairly, obviously the exact circumstances of what's going on were completely different, but the fact that the economy was experiencing a lot of hardships, gold does tend to perform better when there's a lot of uncertainty in traditional markets. We've even plotted before the price of the S&P 500 versus the price of gold to show that when the S&P is going down or kind of just not doing a whole lot, this is when gold typically shines. And if you were to go up to this point again, it would take us to an $8,600 gold. But as we said, we would not expect our parabolic moves to continue at the same rate. And if we were to, give some tolerance there to assume, market maturing, the market becoming more efficient, and, just generally reduced volatility over the macro scale, then you could see maybe we're getting up to like a $5,000 or $6,000 gold, which if we were to come back into our chart, again, if you just look at our, our red line anyways, and then you see what tick market is. So this is $1,000. This would be 2,000, 3,000, 4,000, 5. So it'd be right around say $5,000 to $6,000 in maybe the year 2026, 2027, 2028, 2029. Obviously the exact year that something like that could happen is going to obviously depend on maybe the rate at which we go. The angle of attack on the price. But certainly gold is a way that you can help diversify your investments, precious metals, especially with the economy kind of with a big question mark on it right now as to really where the markets are headed in the short term. So let me know what you guys think about the video. We normally talk about cryptocurrency, but I'm trying to apply a bit more of quantitative finance and whatnot to the charts. And I was thinking about developing something like this, but for gold and silver and maybe a couple other precious metals. So let me know what you think. But the idea is just developing a Monte Carlo approach, a brute force, to try to figure out the optimal portfolio based on your historical returns versus your volatility. We could also put in projected returns, which we'll do in a future video. And then you develop your efficient frontier, and then you can just use some type of quadratic programming to identify what is your most optimal portfolio, which is what we did here. So I'm thinking about doing something similar to precious metals. Let me know what you would want to see. Obviously, I would include gold and silver in the mix. But let me know what other coins you would want to see included in that type of analysis. Let me know in the comment section below Also, check out my Telegram channel, which is also in the description below, if you want to talk about the charts. And make sure you subscribe to the channel. We'd love to have you join to get along for the ride as we explore, quantitative finance and look at trends across asset classes. So I hope you guys enjoyed the video. I'll see you next time. Bye.